So this module is going to focus on investment planning and is primarily tied to retirement planning. I'm going to present this in two ways. So one is for you, because all of us, unless we're independently wealthy, will have to plan for our retirement. And the second is from a HR point of view, particularly for compensation and benefit professionals. That'll be the 2 points of view. So before I jump into it, don't say to yourself, I'm not good at math, because it's really not a lot of math. The other thing, too, is don't say, well, I really didn't do well in finance or I don't like finance, because this is really about personal finance. So intentionally, I'm going to go a little bit slower on this to really make sure that you get the concepts. If you don't get it the first time, don't worry about it. Then just replay those sections or, in part or in whole. That's your decision. So let me start off with a basic fact pattern. 28% of people over 55 have none, nada, retirement savings. So if you look about life expectancy in the United States, where it differs based upon what your race is, it differs based upon what your income is, it differs based upon what your gender is as well. But if you're 55 years old today, you can reasonably expect you're going to live to be 75. So that's 20 years. So then the question is when do you retire? So if you're one of these 28%, you have saved nothing for retirements, Medicare will not kick in until you're 65. That's for health benefits. You can begin to take out Social Security at the age of 62. So you've got 7 years until Social Security kicks in. But you got 10 years before health kicks in. So some people can wait, but other people, if they don't have any assets, they can't retire at 55. But the flip side of it is this. You've still got 72% of the individuals that have some retirement savings. So do they have enough to retire at 55 or not? What you don't want to have happen is you don't want to outlive your money. Because if you outlive your money, and unless you have some benefactors, if you will, you could be in a sad situation financially. And if your financial resources go down, your health resources go down. So it's not a situation that you want to be in. So let's look at some sources of retirement cash flow. So when you think about retirement, regardless of the age of when you do it, is 30 years ago from today, by and large, it was what was called a pension. And a pension was a defined benefit plan or a DB plan. So what I mean by defined benefit plan? So let's imagine that you are 56 years old, you go to HR, and you sit down across from the compensation and benefits professional, and you say, I think I want to retire next year when I'm 57. Compensation and benefits professional says, okay, sure. And then you ask, the question is how much will I get every year until I die? So under a defined benefit plan, HR person, would say, well, let me get on the computer and calculate that, or let me look at this sheet. And they would say, oh, you've been here 27 years. Your, 3 highest incomes while you were here were X. And then they look for that is 30 years, 3 highest incomes, theirs. I have the number for you. So you will get, I'm making up numbers now, you'll get $75,000 every year until age 99. Yep. And there also is a cost of living adjustment tied to the Consumer Price Index or CPI. So you're going to get $75,000 year one, guaranteed, because it's defined benefit. And let's say from 57 to 58, inflation goes up 2%. So then you're going to get that 2% on that 75. So that's built into it. So those are pensions or defined benefits. For a number of reasons, they've gone away. Part of it is and I'm pro-union, so I'm just going to put that out there. Part of the reason is the attack on unions, because unions fought for defined benefits. So again, 30 years ago, it was also Social Security. And Social Security was established during the New Deal. So during the New Deal coming out of the Depression, there were a lot of people that when they turned 55 they retired or they got kicked out of companies. And it was really before unions as well. And if they had no money, they were out of luck. They were just poor unless they had some family members that could take care of them. And then savings. So there really wasn't as much of a need to save because the company took care of that for employees. The government took care of that for employees. So let's fast forward to today. So today you still have those same vehicles. You have a pension, and I'm going to talk about the shift in that. You still have Social Security, and you still have savings. So the three buckets are there, but proportionately the buckets are different. So what's happened today is, if you think about that pension, there is, we have defined benefits, but we also have defined contribution. Think 401k, 403b. So the defined contribution is called a DC. So, and you know how a DC or defined contribution works. So each month or every 2 weeks is money is taken out. You elect to have money taken out on a pre-tax basis. That money is then invested. And your company may or may not provide a match. So they may provide, a 2% match, a 5% match, or a 10% match. And then that money accumulates over time. But that money does not accumulate in a guaranteed fashion like a defined benefit. It's tied to the bond market, the stock market, or any asset allocation. So for the past probably good almost 10 years now, about 8 years, the market has been really doing well. So for those folks that have defined contribution plans, 401k, 403b, IRA, SEP IRA, you're like happy. It's like, this is good news. But remember 2008, 2009. So when the markets tanked. So if you had a defined benefit plan and the market tanked, so what for you as an individual? But for the defined contribution, 401k, 403b, if the market tanks, it makes a difference. You could lose, depending upon your retirement portfolio, tens of thousands of dollars. You could lose hundreds of thousands of dollars. So in some cases, people lost over $1 million. And let's imagine you lose $1 million in your retirement account. And again, you're 56. You wanted to retire at 57. If you were under a defined benefit plan, it wouldn't make a difference. But if you have 401k, 403b, what are you going to do? You're 56. You want to retire at 57. Your investment portfolio just dropped by $1.2 million. What are your options? You work longer, save more, you're out of luck. So I'm being a little bit biased here, and I recognize that bias. I'm in favor of defined benefit plans, and I'm in favor of unions because they kind of protect folks. And that's probably the public health part of me that's coming out, and I'm okay with that. So now let's look at Social Security. So with regard to Social Security, and that's still in place. So you can take it as early as 62, or you can take it at 65, or you can take it at 67. So the longer you wait, the better. So you really need to think about what your life expectancy is, and savings. Because you can also save money that's not pre-tax, but it may be post-tax, outside of your retirement accounts. So what's going to have to happen for folks now is contribute as much as possible, particularly if there's a match, to your company's 401k. If they have a match, contribute, because you're leaving money on the table. And then for Social Security, you have to get enough what's called quarters, and you can get a statement from the Social Security Administration to find out what that is, but continue to save. Because we, in essence, have no more defined benefit plans. And the social safety net is largely eroding. So those are the sources of retirement cash flow. If you're a business owner, you can sell a business. That's another source as well. So let's look at some investing basics for HR professionals. So a famous saying from Warren Buffett: we don't have to be smarter than the rest. We have to be more disciplined than the rest. So what do you think he meant by that? It goes back to saving. So if you have a 401k, are you setting aside those dollars? Are you also setting aside dollars for saving? Recognizing that money grows over time, and I'll show you some slides about the time value of money. So these are just some terms you should know. So an investment is the commitment of any funds into a vehicle, and then with that vehicle, it grows over time, but no guarantee. Hence the risk. A passive investment strategy is when you invest in a vehicle that may be tagged to the S&P, Standard & Poor's, may be tagged to the Dow. So there's not a lot of trading that's going on. It's tied to a market. active investment strategy is where there's a lot of trading. So there's trading of stocks within a particular investment vehicle. So let's look at some other investments. So you have bonds. So all a bond is, it's an obligation and there's a debt. So you have principal and you have interest. So stock is invested in a publicly traded corporation that rises in growth or value. Currency is cash, the dollar. Funds, yeah. So what funds are? Mutual funds, exchange traded funds. They're a basket of stock, could be a basket of bonds, could be a basket of other financial instruments into a fund. And then you invest in the fund, but you don't own any of the underlying stocks, bonds, or investment vehicles. And then gold. So gold could be a gold fund, could be a coin, could be a bar. Real estate. So it could be directly you own a property or could be a real estate investment trust or a REIT. And then any deposits that you may have in a bank, hopefully that are interest bearing. So those are just some types of investments. Now this one's pretty busy. So let's look at what's called asset classes. Look at the gray. I'm going to focus on the gray. So an asset class is how do you categorize different financial instruments? So one is growth. So growth, let's say, is you have $10,000 and you're going to buy some U.S. large company stocks. So you put $10,000 in there. Your holding period or your time horizon is 5 years. You're hoping that it will grow, $10,000, maybe $11,000, $12,000 over time. So that's a growth asset class. There's no guarantee that it's going to grow. It could drop. The next is growth and income. So when you think about income, think about a dividend. So let's say you invest in, again, another large company stock, say it's ExxonMobil, say it's Federated Department Stores. So not only might it be growing, but the board of directors they say we're going to have a dividend. So what happens is in an income stock is it shoots off money. So you actually can get a check unless you reinvest it, every month or every quarter or every year. So that's income stocks. So in general, as you're younger, you want to do more growth. And as you get closer to retirement, you want to do more income because you might need the income to replace the W-2 income that you no longer have because you're retired. So then you also have pure income as well. Inflation is this. It's when the cost goes up. So it's the CPI. So there's certain financial instruments that automatically go up like an escalator with inflation or protect you against inflation. And REITs, which are those real estate investment trusts, tend to be good vehicles for that. Then you have what's called a defensive asset. So what is it defending against? It's defending against a drop in the markets, the stock market, the bond market, cash. So cash is a defensive asset, but if you have cash and you put it in the bank, you can get like 0.2%, but it's defensive. Treasuries. So treasuries are backed by the full faith of the United States government. Gold is a defensive asset, and also some international as well. So if you think about the term a balanced portfolio or to be diversified means is you have some growth in income, you have some income, you have some inflation protection, and you have some defensive assets. So that way you have a diversified portfolio against whatever market conditions may occur. Those are asset classes. So the gray, asset classes, the other colors are just examples. So some might be saying, this is just too risky. But here's the thing. If you have a 401k, if you have a 403b, if you have an IRA, if you have a SEP IRA, you are an investor. You are an investor. So you may not view yourself as an investor. You are an investor. So the key to investing wisely is how do you balance risk and reward? So the reward is I want more income. If it's an income fund, or I want more growth, appreciation, value. The risk is I don't want to lose my money, or I want stable returns. So you have to figure out what's the right risk and reward for you. Some people are willing to take on a lot of risk for a lot of reward. And if they have some of those defensive assets, like a lot of cash, then they're okay. But if they don't have a lot of defensive assets, they may have to take less risk for a little less reward. So let's look at this combination between risk and reward. So if you note on the bottom there, you see risk is measured by standard deviation, and you see annualized return, risk and reward. And the title of this is called the efficient frontier. So this is just a financial concept. So let's take a look at 10% stocks and 90% bonds. So all of these are examples of a portfolio. So at 10% stocks and 90% bonds, there's not going to be a lot of growth. Yep. So if you think about it, your growth is about 6%. But yet, because you don't have too many stocks, the risk is less. So now go to where it says 70% stocks and 30% bonds. So here, again, that's your portfolio. So if you notice you're taking on more risk. Why? Because of the increase in stocks. But your potential for return's a lot greater. So you have to make decisions about that. If you go to the very top there, say you're going to invest in the Standard & Poor's 500 as a passive fund, that's the only investment. So you're 100% invested in the market. So again, it's very risky, because if the market tanks, then you have no backup, but yet the reward is very high. So you have to make a decision, not by yourself, but with investment professionals, retirement planning professionals, about what's the best portfolio for you based upon your risk tolerance, which can be assessed with questionnaires, as well as your chronological age, as well as your time horizon. When do you plan to retire? So diversification. So this is a nice way of looking at diversification. You got your basket there, your shopping basket, and in yours you have $2,500 in a money market. So that's a defensive asset class. It generates some cash through the interest. It's fixed interest, typically for a lock-in for 1 year, 3 years, 5 years, a little bit better than what a bank gives you. So, and if it's protected by the FDIC of the bank, then it's like 100% guaranteed, but it's not a large percentage. You may also have cash. So cash is there. You may have bonds. So it could be an actual bond or it could be an ETF. You also have some stocks as well. So in this model portfolio, you have $2,500 in cash, money market. You have $5,425 in bonds because you bought 2 exchange-traded funds. And exchange-traded funds have a lower fee. They cost less than a mutual fund. So you want to keep that in mind. And then you've bought stocks. So in your stocks, you have 5 ETFs. Again, they cost less overall than mutual funds. You outright own 2 stocks, and you have 3 mutual funds. So if this is your asset allocation, would you say, is it diversified? So is it diversified? Yes or no? It is diversified. Now, real estate is missing, commodities are missing, and gold is a commodity. So there's some things that are missing, but you don't have just one thing in the basket. So now let's look at the tale of 2 asset allocations. So you have one which is 100% of the 401k is based upon one stock. That's bad. That's foolish if you're to do that. So if you've done that, don't call yourself foolish, but get out of that. A better one is you have a proportion of stocks, you have bonds, you have cash, you have real estate, and you also have other. So the other could be commodities. So this next one, this is a famous chart. It's busy, but I'm going to walk you through it. So let's look at 2017. So go to 2017, because what it shows you is the performance of each asset class by year going from 2008 to 2017 with a projection going out 10 years. So Ibbotson, came up with this, and I believe that these go all the way back to like 1927. So 2017, so we have EM. So EM is emerging markets. So in 2017, they returned 37.3%. That doesn't mean that's going to continue forever. So that's in yellow. So go look at what the forecast is for the next 10 years. The forecast over the next 10 years is 1.4%. So the lesson is this, is just because it performed well in 1 year doesn't mean it's going to perform well every single year thereafter. because I want you to look at EM, yep, or the emerging markets. 2008, negative 48% in 1 year, jumped up to 68.9%. Following year, 16.5%. Following year, negative 18%. Following year, 19%. Following year, negative 3.7. The year after that, negative 3.9. Year after that, negative 16.2. Pretty stable trend there, but that's not known in advance. Then you get the 10.9, and then 2017, you get the 37.3. So what is it going to be next year? We don't really know. Yep. Is it going to be, 16%, or is it going to be negative 48%? So those are called asset class returns. So past performance is not a predictor of future performance, which is why you want to make sure is that in your diversified portfolio is you have several asset classes, because it minimizes risk. So let's look at ready to take your first steps in applying some of this information. So this is what I call financial building blocks. So the first one is you want an emergency fund. So you might say, I can't even hardly pay my bills. So an emergency fund is, what if your car breaks down? So are you going to have to put that on a credit card at 24% interest? You're probably not going to get a loan unless you have some collaterals. So just try to build just a little emergency fund. Even if you can set aside $25, $50 a month, an emergency fund and a cushion. In general, when you get to a certain place when you're making more money, not like crazy money, but more money, it's suggested by financial planners is that your emergency fund is 3 to 6 months of what it takes for you to live. So 3 to 6 months. And then protection. So protection is insurance. So life insurance, disability insurance, it's health insurance, it's vision insurance, it's property and casualty insurance, it's auto insurance. So protection. The next is education, and then home and retirement. Going up is investment, and if you have a business. And then finally, estate planning. So estate planning is the transfer of wealth and legacy. So these are the basic financial building blocks that you want to put in place. So where do you begin? So I imagine that for most of you that are taking this class, you're pre-retired and you're accumulating wealth. So you're in that wealth accumulation stage. Go back to the quote by Warren Buffett. You want to be disciplined. So you mean you got to save. And then you will come a time where you're going to be retired, hopefully, and then you're going to distribute. Yep, you're going to spend down that which you have built up. But you can't distribute nothing. So you have to build it up, and then you can distribute. So there's a concept called the time value of money. The basic lesson is this: start as soon as possible and become a millionaire. So here's the scenario. Let's assume that you make a $2,000 annual contribution to an account. So it could be a fund of some sort. So until the age of 65. So every year you're going to write a check, put $2,000 in a fund. Every year, $2,000 in a fund. But then you have to look at the interest rates. So how much are you earning on that money? So let's begin with the 3% interest rate. So again, so let's say you start at the age of 20. So you put in $2,000 every year, beginning at the age of 20. And then at a 3% interest, if you do that, and just that, by the age of 65, you'll have $185,000. But let's say that you started at the age of 50, because you said, I can't find $2,000. I just can't do it. I don't have the money. And then all of a sudden you're 50 and it's like, oh my God, I think I want to retire in 5 years. I haven't saved. I got to do something. So you put the $2,000 starting at the age of 50, again at 3% interest. You've saved. You've got $37,000 in the account. But had you started at the age of 20, you would have had $185,000. That's called the time value of money. Now let's drop it down to a 10% interest rate. If you can, take that $2,000 and you start at the age of 20, you're a millionaire. $1.4 million. $2,000 annual contribution beginning at the age of 20 for the next 45 years at 10% interest rate, you are a millionaire. Warren Buffett said, it's not about being smart, it's about being disciplined. So are you disciplined enough to put $2,000 away every year? Are you disciplined enough to put $2,000 away every year? Are you disciplined enough? You may say, well, what am I getting out of it today? You're getting nothing out of it today. But look what you could get out of it 45 years from now. Then some might be saying, I'll be dead in 45 years. Do you know that? Do you know that? And if you decide to have children or nieces or nephews, what about them? So legacy. Those are all personal decisions that you have to make. But again, start as soon as possible and become a millionaire. So we believe wealth is not measured in dollars, but in the absence of financial worry. Now, if you're under the age of 40, you're probably not worried about retirement. If you're 40 plus, you think about it occasionally. If you're 50 plus, you're thinking about it more. If you're 60, you're probably panicking or in denial. But if you've set things aside because you're disciplined, $2,000 a year, $2,000 a year, then you can reduce the worry. You can reduce the worry. Not just worry for you, but worry for those people that love you and those people that care about you. So with that, hopefully you have a good understanding of investment principles for you as well as a HR professional. Thank you very much.